China's $850 billion nuclear option. Will it shatter U.S. mortgage rates? You've probably heard whispers that China has a new kind of weapon and that it's aimed directly at your mortgage. The story goes that a huge, coordinated sell-off of U.S. debt has already started, all designed to make the cost of buying a home skyrocket, no matter what the Federal Reserve does. This isn't just some future prediction. The numbers show a definite trend happening right now, largely under the radar. For decades, we've been told that the Fed controls mortgage rates, but what if that's only part of the story? What if a major foreign power can now influence the terms of your home loan, your car payment, and your credit card interest? In this video, we'll break down the financial pressures that are already in motion. We'll explore the mechanics of this economic shift, why it's happening, and most importantly, what it means for the future of the American housing market and your wallet. The Great Uncoupling, a 40-year alliance ends. To really get what's happening, we need to rewind the clock. For about 40 years, the US and China had a weird but working economic relationship. It was pretty simple. America bought stuff, and China made stuff and saved the money. As Americans bought TVs, phones, and furniture, trillions of US dollars flowed to China. China needed a safe place to put all that cash, and the safest, easiest to sell investment on earth has always been US government debt, treasury bonds. So China became one of America's biggest foreign bankers. They bought our debt, which helped keep our interest rates low, letting us borrow and spend even more. At its peak, China held over $1.3 trillion in U.S. Treasury securities. This relationship powered the global economy. But that era is clearly changing. We're now witnessing a major financial decoupling, slowly at first, and now with more momentum. China is unwinding its position as a top creditor to the U.S. The numbers are staggering. According to the latest U.S. Treasury data, China's holdings of U.S. government bonds have plummeted. As of late 2025, their official Treasury holdings have cratered to a 17-year low, sitting at about $682.6 billion. That's a drop of nearly half from its peak. This isn't just a small change in an investment portfolio. It's a deliberate strategic shift away from the U.S. dollar system. The message is clear, the dynamic is changing, and now the bill is coming due, and American homeowners could be the ones footing it. How selling bonds affects interest rates. So how does China selling bonds in Beijing put pressure on your mortgage rate in Boise, Idaho? It's not as complex as you might think. It boils down to the most basic law of economics: supply and demand. Think of U.S. Treasury bonds as IOUs that the government sells to pay for everything from military salaries to road construction. For decades, China was one of the most reliable and deep-pocketed buyers of these IOUs. Now imagine that major buyer doesn't just stop buying, but also starts selling off the bonds they already own. Suddenly, the market has a lot more supply, and one of the biggest buyers is gone. What happens when you have too much of something for sale and not enough buyers? The price drops. In the bond market, when a bond's price falls, its yield, a fancy word for the interest rate it pays, goes up. To attract new buyers for all that extra supply, the seller, the U.S. government, has to offer a better deal, which means a higher interest rate. And here's the critical link. The interest rate on the 10-year U.S. Treasury bond is the main benchmark for the 30-year fixed mortgage rate in America. They tend to move in the same direction. When the 10-year Treasury yield goes up, mortgage rates often follow. So, when a major holder like China sells U.S. debt, it increases the supply of bonds on the market. To find new buyers, the yields on those bonds may need to rise, and as those Treasury yields rise, your potential mortgage rate can rise with them. The Federal Reserve can cut its own short-term rates. but it might not matter as much if selling activity from foreign powers is putting upward pressure on the long-term rates that actually determine your mortgage. More than just treasuries? Now let's talk about the idea of an $850 billion weapon. This figure has been used to describe the combination of China's holdings, but it's not an official number. The true financial picture is more complex. The shift in China's strategy appears to have two parts. The first is, of course, the U.S. Treasuries, which we've seen have fallen dramatically. But the second, less obvious part of this financial leverage involves something called agency debt, or mortgage-backed securities, MBS. These are bundles of thousands of home loans from institutions like Fannie Mae and Freddie Mac. For years, China wasn't just buying the U.S. government's general debt. It was also buying up American mortgages packaged as these securities, and it's among the largest foreign holders. Some reports have indicated that China is reducing its exposure to these assets as well. When you combine China's massive, though declining treasury holdings, around $683 billion, with its significant holdings of this agency debt, you get a sense of the financial leverage at play. While the exact total fluctuates and isn't officially confirmed at $850 billion, the concept illustrates the combined power they could wield. By selling both treasuries and MBS, China could create a perfect storm. The treasury sales could push up the benchmark interest rate, while any significant selling of MBS could impact the mortgage market more directly. While many analysts describe this as a diversification strategy to reduce risk, it's hard to ignore the geopolitical context. This isn't just portfolio rebalancing, it's a financial realignment in an era of growing global competition. So why is China doing this now? Why unwind a relationship that has been so beneficial for decades? The answer seems to be a single powerful motivation: de-dollarization. Beijing has made it a strategic priority to reduce its dependence on the US dollar and, by extension, America's influence over the global financial system. For years, America's exorbitant privilege has been its ability to print the world's reserve currency. This allows the U.S. to borrow cheaply and apply powerful financial sanctions. From China's point of view, holding massive amounts of U.S. debt isn't just an investment, it's a vulnerability. Selling U.S. debt can be seen as a defensive move to shield itself from these risks, but it could also be viewed as an offensive one. In the context of ongoing trade disputes and tech blockades, this sell-off is a form of economic pushback. It's a way for China to respond not with military force, but with financial pressure, targeting a sensitive area of the U.S. economy, its debt and housing markets. So where is all this money going? It's being systematically converted into hard assets, most notably gold. For more than a year, China's central bank has been on a gold buying spree, dramatically increasing its reserves. This is a classic move for a nation preparing for a shift in the global order, trading paper promises from a rival for a neutral store of value. Some Chinese economists have been surprisingly direct about this. One professor at the Shanghai University of Finance and Economics stated the goal is to strengthen the overall safety and stability of the portfolio. Another chief economist went further, reportedly telling the South China Morning Post that America's massive debt looks like a Ponzi scheme and that China doesn't want to play this game anymore. If you're finding value in this deep dive into the hidden forces shaping our economy, take a second to subscribe and hit that notification bell. This channel is all about giving you the analysis that mainstream financial news often overlooks. We're going to dig into what this means for your budget right after this. Let's bring this down from the world of geopolitics to your kitchen table. What does even a 1% or 2% rise in mortgage rates influenced by factors like this foreign pressure, actually mean for you? The numbers can be shocking. Let's take a hypothetical $400,000 home loan, which is pretty standard in many parts of America today. At a 6% interest rate, your monthly principal and interest payment is about $2,398. Now, let's say a combination of factors, including reduced foreign demand for U.S. debt, pushes mortgage rates to 7%. Your monthly payment for the exact same house jumps to $2,661. That's an extra $263 out of your pocket every single month. Over 30 years, you'd pay nearly $95,000 more in interest. What if that pressure intensifies and rates hit 8%? Your monthly payment becomes $2,935. That's an increase of $537 a month compared to the 6% rate. Over the life of the loan, you'd pay an incredible $193,000 more for the same house. This is the potential cost of this financial shift paid by you. It can be the difference between an affordable home and being priced out, or between building equity and being stuck renting. And the impact doesn't stop with mortgages. Remember, U.S. Treasury yields serve as a foundation for almost all consumer debt. When they rise, interest rates on car loans, credit card balances, and student loans often follow. This creates a challenging situation for the Federal Reserve. They may want to lower rates to boost the economy, but their actions can be counteracted by these powerful global forces. There's another hand on the steering wheel, and it's pushing us toward higher interest rates. As significant as China's actions are, they aren't happening in a vacuum. This isn't a solo act. A broader, quieter exit from U.S. debt is taking place. Japan is now the largest foreign holder of U.S. debt, but Japan is facing its own economic issues and the need to support its currency, the yen, which has led it to also reduce its U.S. Treasury holdings from their peak. Other major players are making similar moves. Countries in the BRICS bloc, like Brazil and India, have also been notably reducing their holdings of U.S. Treasuries. This isn't necessarily a coordinated plot, but a collection of individual decisions that add up to a powerful trend. Even traditional U.S. allies in Europe are diversifying their reserves. This trend suggests a growing lack of confidence in the long-term stability of the U.S. dollar as the sole reserve currency. For decades, the world ran on a dollar standard. Now we may be shifting toward a multipolar asset standard where gold and other currencies play a bigger role. The problem for the U.S. is that our economy is built on the assumption of cheap credit funded by the rest of the world. With net interest payments on the national debt already crossing $1 trillion a year, the consequences are serious. Without China's huge appetite for our debt, and with other countries now reducing their share, who is left to buy all these bonds? The answer is new buyers who will likely demand much higher interest rates to compensate for what they see as growing risk. So, what can you actually do about this? This isn't financial advice, but it is a wake-up call to a new financial reality. The first step is just being aware. Understanding these huge tectonic shifts in the global financial system is no longer optional. It's essential for anyone who wants to protect their wealth. The era of ultra-cheap debt that defined the last few decades appears to be over. The old assumption that you can always refinance to a better deal is becoming a dangerous one. In this new world, debt carries a much greater risk. This makes financial literacy more critical than ever. It means understanding your own finances, being smart about taking on new loans, and recognizing that decisions made halfway across the world can hit your wallet almost immediately. The world is changing. Navigating the friction between the old dollar-centric system and this new emerging landscape will be the defining economic challenge of the next decade. Being prepared doesn't mean panicking. It means paying attention, learning, and adapting. What we've laid out today isn't a conspiracy theory. It is a documented, data-driven shift in the global balance of power with real-world consequences. China has begun to systematically reduce its financial ties to the United States, primarily through a gradual sell-off of U.S. debt. While this is often described as simple diversification, it's a clear move in a larger geopolitical game. It's a financial maneuver that directly impacts the foundation of American economic stability, the U.S. Treasury market. By increasing the supply of U.S. bonds on the global market, China and other nations are putting upward pressure on the interest rates America must pay to fund itself. Because mortgage rates are so closely linked to these Treasury yields, the American housing market is caught in the crossfire. This trend has the potential to make homeownership more expensive and to challenge the Federal Reserve's control over the U.S. economy. The cost of the American dream is now being influenced by forces far beyond our borders. What do you think? Is this a calculated economic strategy or just a smart financial move by nations securing their future? Let me know your perspective in the comments below. And if you want to keep exploring the forces that are truly shaping your financial future, make sure you're subscribed. Thanks for watching.